Most people think that losing money in the stock market is a technical failure. They believe they missed a chart pattern, misread a balance sheet, or bought the wrong asset. But that is a lie. The vast majority of retail investors lose money not because of a lack of financial data, but because of a total collapse of emotional discipline. When the market starts to crash, and the screen turns into a sea of flashing red, your brain undergoes a physical, evolutionary hijack. If you want to survive as an investor, you don't need a better algorithm. You need a better psychological defense system. Today, we are going to break down the cold, hard science of market panic, and the exact frameworks professional traders use to maintain absolute calm while everyone else is destroying their own net worth. To understand why a market crash causes such catastrophic decision-making, we have to look at human evolutionary biology. Your brain was not designed to trade global financial markets, it was designed to survive on a savanna. When you see your portfolio drop 20% in a single day, your amygdala, the ancient, emotional part of your brain, registers that financial loss exactly the same way it registers a physical threat. It triggers a fight-or-flight response. Your heart rate increases, cortisol floods your system, and the prefrontal cortex, the part of your brain responsible for logic, long-term planning, and mathematics, effectively shuts down. This is the exact moment retail investors make their biggest mistakes. They panic sell at the absolute bottom because their brain is screaming at them to escape the pain. Then, they watch from the sidelines as the market recovers, only to buy back in at the top out of FOMO. Your emotions are being traded against you. Algorithms and institutional market makers thrive on this exact retail panic. They buy your forced liquidation at a massive discount. So, how do professional risk managers completely bypass this biological trap? They don't rely on willpower. They rely on strict rules that remove emotion from the equation entirely. The first rule is correcting your position sizing. If a 10% drop in an asset makes your heart race, keeps you awake at night, or forces you to check your phone every 5 minutes, your analysis isn't wrong, your position size is. You are playing with money you cannot afford to lose. Fear is directly proportional to your leverage. When you size your positions correctly according to your actual risk tolerance, a market crash ceases to be an emotional crisis, it simply becomes a statistical event. The second rule is moving from outcome-oriented thinking to process-oriented thinking. Amateurs judge the quality of a decision based solely on the immediate financial result. Professionals judge the quality of a decision based on whether they followed their pre-established rules. If you bought a great asset with a solid thesis, and a macroeconomic shock crashes the price, the drop is out of your control. Panic selling breaks your process. Sitting still, or executing a pre-planned accumulation strategy, honors the process. The third rule is executing a total information diet. When blood is in the streets, the financial media industry makes billions of dollars by selling panic. Headlines will tell you that the world is ending, because fear generates clicks. Professional investors do not sit and scroll through social media or panic-driven news feeds during a crash. They close the charts, step away from the screen, and allow the noise to clear. A market crash is not a tragedy, it is a giant macroeconomic filter. It ruthlessly transfers wealth from the undisciplined, emotional participants to the automated, structured ones. If you treat the market like a casino to get a hit of dopamine, the market will eventually take everything you have. But if you can build a mental edge, manage your position sizing, and master your own evolutionary flaws, a crash stops looking like danger. It starts looking like the greatest wealth-building opportunity of your life. If you want to keep mastering the psychological and honest rules of money, make sure to subscribe. I'll see you in the next episode.
You